Hello and welcome. So we all want to make some money in the stock market, and I think there might be an angle here on Visa as a high quality investment. Let's take a look at Visa together. Quick note before we start, this is not investment advice for you. This is my review of Visa. If you want to buy Visa or even sell or hold, please do your own research and take your own advice. That disclaimer out the way, let's start the review. Okay team, so I'm here on TIKR Terminal, which has got a good long-term history of financial information. Get to the financials. So I can look back at the income statement for the last, back to 2013 to start with. The first thing to note is the revenue for Visa. Graph that field, and you see the revenue is growing consistently over the period, which is fantastic. Very nice growth. And I like to look at the gross margin, and that gross margin is incredibly high. So the cost of each additional sale is negligible. So massive gross margins. And you can see on the page here the operating margin as well. So the revenue's been going up, the gross margin's been consistent, and that operating margin's been relatively consistent as well. So they're able to turn the extra sales into extra profitability very well. And those operating margins are incredible, over 2/3, so 67%, really, really good. And that leads us to net income that is increasing over time also. And there is the net income graph, so beautifully increasing. That's the main part of the income statement. That looks incredibly positive for me. Now, the other things to note is I also look at shares outstanding. So you've got here the change, which is quite useful on this site, year to year. And we can see here the change year to year is negative every year, around about 2%. So they're dropping 2% of their share numbers outstanding each year. So doing a consistent level of buybacks. Good in the sense that it's generating additional return, though we should say that buybacks are only really value adding if they're done at a value that's below the intrinsic value of the company. We don't know the answer to that question, but the general trend of buybacks is, I would say, overall positive. We can then look at the dividend per share going up from 35 cents, 42.50, all the way up to 165, consistently increasing every year. Change year to year is always, apart from 1 year, which is pandemic year, above 10%, and even that was 9%. So the dividend is growing 10 to 20% per year. That is excellent. The payout ratio, the affordability of the dividend is still really good. 22%, always below 30%. So they could even double the dividend if they wanted to, and they can afford it. Now they don't double the dividend for a reason we'll see on another page with return on capital. Now, the balance sheet for Visa, we've got total current assets and we've got total current liabilities. We look at the graph, the current assets in black, the current liabilities in green. Current assets are always above and notably above the current liabilities, means their ability to pay short-term bills, day-to-day expenses, and so on is very, very good, so less likely to fail. Now, we should note here there is some long-term debt that's been going up a little bit, 15 to 20 billion. Overall, the equity is increasing, which is a positive sign. Now, the cash flow statement, which is a translation of net income to cash from operations minus capex to get to free cash flow. So, cash from operations is getting much larger. This line you can see highlighted. Capital expenditure is very low. We're looking at less than 5% or so. So less than 10% in most years. They don't have to spend that much on the capex, so that their operating cash flow translates very well to free cash flow. That's important for me as an investor, because Warren Buffett says free cash flow is essentially your owner's earnings, cash that I'm entitled to if I own past this company. Here is the graph of free cash flow. Again, a beautiful upward trend. 10 years ago it was 2.5 billion. It's now 18 billion. So an investment to Visa 10 years ago, absolutely incredible investment would have been. And in hindsight, looks like a no-brainer because thinking about what they do and the move away from cash and the fact that not all the world has got access to this technology yet would have been fantastic investment 10 years ago. But do comment below if you were on Visa a long time ago, because hats off to you. Free cash flow change year on year, pretty big years, and there's a couple of negative ones. The main negative one being pandemic time. Overall, clearly going up and very high free cash flow margins. That takes me to ratios, and my favourite ratio on capital for the quality companies. And this has always been above 18%, dip in 2 of the years, which when actually free cash flow is lower, I believe. Generally speaking, it's above 20% and has actually pushed up to 30%. And that is why they don't pay all their money out as dividends, because they're actually quite good at reinvesting their money. So therefore, they've got something they can reinvest into to grow the business at this rate of 20 to 30%. That's generally better than paying out dividends to the shareholders. We saw earlier with the assets, current liabilities, current ratio is good. Debt to equity here, round about 50%, relatively stable, not a concerning value. And then the EBIT interest expense is the interest cover. And I want something to be 16 or above, really. This is at 37, so they can very much afford to pay the interest expenses that they have. So I'm not concerned about the debt that they've got. My assessment would be they're probably unlikely to fail. On the trailing multiple, we can see their dividend yield is consistent. So the value of the company in relation to the dividend appears pretty consistent. PE ratio, for those of you that are interested, I don't really use the PE ratio, but it seems to be consistently around about, apart from a couple of jumps, but around about the 30 mark seems to be its sort of normal value. Information on the ticker terminal. I'm going to switch over to Simply Wall Street now. Now, a nice little graph here on the earnings revenue. I like this graphical format. It's revenue, gross profit, and earnings. So their net profit margin, their final profit essentially, saying 50%. It's absolutely brilliant. Simply Wall Street is saying they're overvalued through their mechanism. I don't agree with that, and I'll come to that if you watch to the end of the video. One bit of key information we're going to need here is this 10.6%. So they're saying earnings are going to grow at 10.6% per year. And EPS growth rate, which presumably therefore with buybacks taken into consideration, is 13%. So you could say something like 13%, 10.6 to 13% growth. See, the balance sheet looks pretty stable. Okay. See that dividend per share growing consistently. It's to Yahoo, who is saying 15.5% growth per year in the next 5 years, which is considerable. For those of you that are interested, there is an analyst review here that most are saying buys or strong buys. So here is my summary of Visa in my usual 5 steps. With the chance of failure, I think it's very low. The debt to equity is good. The dividend's very affordable. They're a leader in their sector. And we might also say MasterCard coming to that category as well, and American Express. Interest cover is very good, and the current ratio is decent. So overall, it looks unlikely that they would fail. So it passes my first test. My second test for Visa is that it's a good return on capital. That return on capital in the high 20s, average over a long period of time. Gross margin averaging close to 100%. Operating profits incredible, averaging well over 60%. They convert their profits to cash very well. They've clearly got a moat. Third area of other factors, the industry and activity is very suitable. Dividend, although not buying it for dividend, it's clearly growing every year consistently, and the payout ratio means it's good. They're also doing buybacks, so they're generating value through growing the business, paying dividends, and also buying back shares. Dividend actually probably the least of those points. And growth is predicted from 13% growth, we get to the valuation. Through discounted cash flow, I estimate their value, the rate of return rather, at the current price. Price of my analysis was $227 per share for reference. I reckon there's 9.9 to 12.4% annualized return. And if you use the alternative method of free cash flow yield plus the growth rate, free cash flow yield is about 3.8%. That's a 16.8. So therefore, I estimate the return from investing today basically 10 to 17%. So my decision is that Visa is a quality company. I've got a cash position of over 20%, which is obviously being eaten by inflation. Why not put my money into Visa that's growing 13% a year, paying a small dividend, generating value through buybacks. The valuation of Visa, I'm not looking at the PE ratio of 31. I don't care about the PE ratio. More interesting free cash flow yield for this sort of company. That is very similar to and in line with the S&P 500. So it's not more expensive than the market, even though PE of 31 might suggest it is. Return to the required range, I say 10 to 17%, although noting, of course, there's no margin of safety in that position. But I'm very confident this is a high quality company. So many customers, millions upon millions of customers. Chance of failure isn't there. So I'm buying a starter position in Visa, use some of that cash position in my portfolio. I'll probably buy 1% of my portfolio. And if that free cash flow yield comes down to 5%, for me is a market price of 171, and I'll double that position. If somehow it gets to 6% and the market price is about 143, I'll double it again. And if it gets to 7% and the market price is about 122, I might even double it again. So that is the plan for Visa for me. Hope you found that useful. Thank you ever so much for watching. Check out this video here. This video really help you boost your investing and give you a great idea. Check it out. You don't want to miss it.